So congratulations, Earl, on over 200 ticks in gold yesterday. Nice move. All right, let's go over the setup. We have a nice little trade here in crude oil this morning to start out the morning. Hey, Ladder. Hey, Tom. If we look at what do we do is what we look at is we have a market profile chart over here. The black chart is a market profile chart. We got volume and price-based profile. Volume more solid line, solid blue, solid red, solid green. Control points the most volume that's traded. There's your blue control point. High value is red, low value is green. And what we do is that's more volume based. So we're looking for those to be support and resistance when those lines lock themselves in and stop moving for support and resistance with trend retracements. Consequently, we do have the same levels, high value in the dots, low value in the dots, low value being green, high value being red. So anything you see in high value on the black chart is high value area. Anything in red, anything in green is low value area. What we try to do is we look for our trend filter. Our trend filter is built in. We don't use moving averages for support and resistance, but we use them for trend direction. Moving averages are worthless for support and resistance, but they're great for trend direction. We look at this magenta moving average that's built into our market profile. If it's angled up, we want to look for trend retracements. We'll look for buys. So as you can see, we've been trending up all morning since around 3 a.m. this morning. We had a breakout earlier this morning, break retest, high value, and that got the market going up. So we recently had this pullback to the control point. Control point is support, and that created a buy opportunity. Consequently, at the same time, over here at J signal, the white chart we use for setups also. The easiest way to find the J signal setup, I don't have the control point on the J signal over here. I do have the high value and low value area. Same color, high value red, low value green. The easiest way to trade J signal, if you get outside of high value, the market is showing strength. You see it closed outside of high value. You're going to look for the first retracement, look for the blue Fibonacci dot to pop up. Once the blue Fibonacci dots start firing off, then you're in an area of support or pullback that we're going to look for a market delta. So what we have is we have a pullback to the control point, and at the same exact price point in time, we got to pull back to a break of HVA retest on our Fibonacci pullback. Once this happens, we're going to go over to our market delta chart. We use market delta last. We do not use it first. The market delta shows us the order imbalance, and that will show us an imbalance of orders to get long or short the market. So what we'll do is once we get down to the control within a couple ticks, or we get a pullback and the blue Fibonacci dots start firing after breaking HVA retesting or retracing, we're going to really watch the market delta. We do not want to buy until it closes green. Here's red market delta, then it closes green. Anything over 200 is a major order imbalance on crude oil using my 5-sim Renko. That's the only one I use on crude oil, is my Renko bar chart. And when at 391, once that closes, you can open the position up. You're going to have a hard catastrophic stop of 15 ticks. We don't risk more than $150 per trade on crude oil per one contract. Once your order is filled, you're going to place your stop loss 2 ticks below this swing low. So right when you get the order filled, 2 ticks below the swing low will be your stop. And that is going to put your average stop right around 12 to 13 ticks, depending on your fill. It's usually an average of 13 ticks, 12, 13 ticks will be your normal stop. So you're risking $130, $120 on this last trade. All right. As you can see, the market moved up. The fill was 52 long. Got as high as just over 72 long, 73. So there's a $200 trade on this last push up. Now, what you want to do as it moves up You can scale using two techniques. You can scale using looking at my market profile over here. You can see we have resistance of the high value area as it's moving up. And then we also got resistance on my symmetry dots over here. So what you can do is you can scale 2 ticks in front of symmetry dots over here. Scale contracts, scale 50% of your position, or even scale 50% going into the next market profile and then see if the runner can run. So that's a nice little trade setup on the last one. Now, if the position's going to be wrong, if we're going to be wrong in the position and we don't want to wait for the whole 13 tick stop out, we can watch market delta in the infancy of the trade. So in other words, if it closes green, we open the position up. But if it closes red on any one of these bars, the first one particularly after we enter, you want to stop yourself out at a small loss. I don't care if it's a $50 loss, $60 loss, $70 loss, $80 loss per one contract, whatever it is. Because if we don't got order flow imbalances falling up after a buy setup, you're not going to have really good follow through. So you can just stop yourself out and you're good to go. Okay? That's exactly what we do. So we use these two charts. My methodology is very simple. We use the black and the white chart to find the setups. And we use mark to find the area of support and resistance. We want to find stack levels where profile stacks over top profile. Because remember, I got 3 profiles here. I got 2 on the black chart, the solid lines. I got control, high value, and low value. The dotted lines are more price. Price has been around since 1985. Volume's been around since 1994. Been working that long. And then you go over to J signal, the white chart. I got high value and low value, which is more developing. So those are 3 levels of profile. So when those levels stack over top each other, if you get 2 out of 3 that stack over top each other, you got a major brick wall. A lot of times you have 3 stacked over top each other where 3 are at the same price point in time. That would be the best setup you're going to get for support and resistance. Okay, move over to gold, Gerald. If you take a look at gold, the same thing. If we look at gold, Gerald, move over. You can see what we done on gold. We came down to the low value area and we had some Fibonacci buy setups. And if you look at these inflection points, you can see that we had a breakout of a high value area, first retracement. Breakout of high value area, retracement. Breakout of high value, retracement. So what you do, use the same concept. You're going to be looking for a buy and balance to try to get these moves up. Buy and balance, get the move up. Buy and balance, get the move up. Buy and balance, get the move up. The more retracements you take after breaking HV on the J signal, the weaker the trade becomes. So the first one's the best. So once you break out a high value first retracement, that's going to be your best one. It'll be your best one. It should be your longest, what is a wave 3 up in Elliott wave. But the same thing over here on the black chart. You got the control point found support down there. So we had the control point finding good support. Consequently, at the same time, we got our Fibonacci dots firing off retracement buys. So those 2 charts really feed off each other. And they really give you a direct impact on support and resistance. So what we're trying to do is we're looking for market profile to set it up with Fibonacci pullbacks. And we're looking for market delta to pull us in with low risk. And that's a whole methodology what we try to do every day in all markets. Now, this will work in all markets. Now, remember, if you take like this gold trade, if you get in here at 105, anything over 50, by the way, on gold is a big order imbalance. This is 105. So that's a huge order imbalance at 105. Anything over 50, I use a 4 Simrenko on gold. I only use a 4 on gold. I don't use anything else. So 105 imbalance, anything over 50 is big on gold. Anything over 200 is big on crude. So that gave a big order imbalance. So your fill on the last gold trade, 77.60. It got as high as 79.30. So another $200 trade just happened again on gold. And what happened was we have a breakout of high value showing strength, breakout of high value in the black chart, retest high value showing strength. So you got support coming on a retest of high value. We don't buy high value in uptrends. We're smarter than that. We're more educated than that. We know we let high value break, let it retest, look for market delta to turn positive. And then look at your Fibonacci dots, how they fired off also. So just a beautiful setup on both gold and crude this morning. You can't screw that up even if you tried this morning on both markets. They're both trend-directed trades. If you look at gold, we're up in an uptrend. Look at the trend filter. Trend filter's up. It's not down. We are up. You buy retracements. You don't sell high value. You let high value break, let it retest, market delta long. Okay? So if you look at both, it works on all markets the same way. Gold and crude were the same exact setups. Exactly the same. Control point long, Fibonacci long gold. Control point long, Fibonacci long crude.